Hello friends, today let us talk about multi-bagger stock Kaynes Technologies. Before the recent slump that started in first week of Jan, this stock had given about 146% returns in just 1 year. Now it has fallen about 40% or so since I last checked, and hence it's possible that it is at a more reasonable valuation right now, and it could be attractive to some of the investors looking to invest in this stock. Kaynes is mainly into assembling electronic parts like chips or processors, transistors, capacitors into a printed circuit board or what is known as the PCB, which is a bare bones green board on which you would place the chips or processors, transistors and capacitors. Their job is not to manufacture the board or its components like the chips and processors and transistors and capacitors, but just to assemble them into the board and convert it into a functional electronic part. This process is called PCBA or PCB assembly, which is printed circuit board assembly. This assembled board is used in various applications, and mainly for Kaynes it is mainly used in cars and bikes including the EVs as say MCUs and as a BMS battery management system, or as the dashboard console also even in the ICE vehicles. They are used in medical devices, industrial equipments, home appliances, and a few other applications as well. They are also into what is known as box build assembly, which means they are also involved in creating finished products after assembling these printed circuit boards or the PCBs. What this means is post-assembly PCBs can be placed inside a box or an enclosure. They do the wiring, place the buttons, fix the screens, and after thorough testing, package the whole thing into a product like a vehicle dashboard, a smart meter, EV charger, or even a smartphone or an industrial machine. This manufacturing process taken up by Kaynes is part of what is known as the ESDM or Electronic System Design and Manufacturing. The reason why the stock price is up with a high PE even after the recent correction is because of their good numbers and also because of their future expansion plans. So let us talk a little bit about the expansion plans, the opportunities, and also the financial numbers for this firm. First, let me elaborate on the opportunity that is available to the ESDM firms like the Kaynes Technologies or Dixon or PG Electroplast, or other could be the Amber Enterprises. So these are the EMS companies involved in this sector. And let me talk about the tremendous opportunity these companies are sitting upon. Indian ESDM industry is expected to grow by a CAGR of 32.5%. That is 32.5% every year. In fact, from US dollars 29.41 billion recorded in FY 23-24, it is expected to reach 72 billion by FY 26-27. This sector's growth is fueled by factors like Make in India schemes towards localization of manufacturing, China Plus One strategy being adopted by certain countries, rise of EVs, and also due to increase in domestic consumption here in India. To go to one example, EVs need PCBAs like battery management system or BMS. They need multiple MCUs, and hence assembled PCs are more complex and more in number in EVs than in those you could find in an ICE vehicle. Also, Kaynes is looking at enhancing their portfolio targeting the EV charging infrastructure as well. As you can see from the table, Kaynes has been growing phenomenally in the past 3 to 4 years with more than 50% growth in revenue every year. In the quarter 2 of this fiscal year, they recorded a 58% jump in revenue and 86% increase in profits year over year. While the FY24 revenue stood at 1805 crores, that is 1805 crores, the company had initially guided for a revenue of about 3000 crores in FY25 with 15% EBITDA margins. Recently, the management revised this figure downward a little bit and guided for a slightly lesser figure of about 2,800 to 2,900 crores. That is about 100 to maximum of 200 crores less due to order delays, and stock got hammered due to this correction. Later, the management clarified that this revenue correction is not a permanent loss of revenue but just a deferred one where the additional 100 to 200 crores will will get reflected in the next fiscal year, that is FY26. The company has indicated that they see better than expected numbers in the last 2 quarters of FY25, that is this fiscal year. The numbers during the first half of this fiscal, according to the management, was a bit subdued due to the Lok Sabha elections in May, when the government support and projects were a bit subdued, were on the lower side. Hence, the revenue in the last 2 quarters of FY25 would be much higher than what they had seen, that what we have seen in the first 2 quarters of FY25, this fiscal. In FY26, the management expects about 50% growth in revenue, and in Q4 of fiscal year 2026, we will see some semiconductor revenue trickling in as well. I'll talk more about the semiconductor business of Kaynes a little later in this video. In FY27, the revenue is expected to see a 30 to 40% jump with margins around 15%. In FY28, the company hopes to generate about $1 billion or about 9,000 crores of revenue. About 7,000 crores of this revenue will come from the existing EMS business, which involves the PCBs. 1,500 crores from the outsourced, what is known as the outsourced semiconductor assembly and testing, or the OSAT business, which is the semiconductor business that I talked a little bit earlier. And 500 crores will come from the PCB manufacturing, not the PCB assembly, PCB manufacturing. More on that again a little later in this video. Again, the management expects the margins to be around 15% or a little more than 15%. Kaynes has also ventured into building what is known as smart meters, the devices that track electricity usage and send the data automatically to the power utility companies. This smart meters business is expected to bring an additional revenue of about 1,000 crores in the next 1 to 2 years from now. For earnings growth projections for this company, the management has a very simple formula. Let me present that to you. They had guided for roughly 200 crores of profits in FY24, 300 crores in FY25, 400 crores in FY26, and finally 500 crores is expected as profits in FY27. Hence, we can expect the stock price to move accordingly as the EPS improves over the next 3 to 4 years. Now let us talk briefly about the expansion plans of Kaynes and how it plans to grow in future and generate more revenue, especially from the new OSAT and the PCB manufacturing facilities. The Tatas, with a partner in Taiwan, and Adani's partnering with a firm in Israel, are getting into chip manufacturing or wafer fabrications for semiconductors. And Kaynes, meanwhile, is getting into what is known as packaging and testing of semiconductor chips, which is OSAT, which involves cutting, dicing, packaging, assembly, and testing these chips produced by the Tatas and Adanis. What this will do is it will help bring the complete semiconductor value chain to India. Kaynes is setting up a state-of-the-art OSAT or semiconductor assembly and testing plant in Sanand, Gujarat. The company plans to invest about 3,300 crores for this plant, out of which central government will fund about 50% of the expense for this plant as part of their Make in India initiative. And additionally, Gujarat government is also offering a subsidy of 20%, which implies about 70% of the cost of setting up this plant is government funded. Kaynes Technologies share will be about 1,000 crores out of 3,300 crores, and the rest of the amount will come from the governments, that is the state and the central governments. About 50% of the 3,000 odd crores of capex for this OSAT business will be spent by FY27 and rest by FY30. So the complete setup will be ready by FY30. So this is a long game of about 3 to 5 years. Kaynes expects to generate about 1,500 crores revenue by FY27-28, and ultimately when the complete setup is ready by FY30 and the whole capex is completely consumed, their semiconductor business is expected to fetch about 4,000 to 4,500 crores. This is the yearly revenue of about 4 to 4,500 crores from the semiconductor business for Kaynes. Margins again are expected to be in the mid-teens, that is about 15%, similar to what they have for their current EMS business. So this is the plan for the OSAT business or the semiconductor business. Now let us talk a little bit about the PCB manufacturing plans of Kaynes. So the firm is now getting into PC board fabrication or in-house manufacturing of bare bones PC board in a big way. Presently, they just import the bare bones printed circuit board or the PCBs from abroad for their PCBA business, for their existing PCBA business. But in future, they will be manufacturing these bare bones PC boards in-house. About 1,500 crores of capex is planned for this expansion. 50% of this will be spent by FY26 and rest by FY27-28. This business is expected to fetch about 2,200 crores of additional revenue for Kaynes by FY30, when the management hopes to reach about 80% capacity utilization. So the PC board manufacturing together with OSAT, which involves a capex of around 3,300 plus 2,200, so it's about 5,500 crores of capex. Together they can bring about 6,000 crores of additional revenue each year for Kaynes by FY30. The manufacturing plant for PC board fabrication is to be established in Hyderabad, Telangana. There is some talk about establishing it in Mysore as well. Do note that Finance Ministry recently approved about 25,000 crores of PLI for non-semiconductor electronics manufacturing industry for manufacturing electronic components, including the PC board fabrication that Kaynes is getting into. This is one of the best times for electronics manufacturing, and hence companies like Dixon and Kaynes and Amber Electronics are seeing their stock prices soaring in the recent last 12 to 15 months. There is a similar PLI for the semiconductor manufacturing as well, which is called the ISM 2.0, which is, I think, Indian Semiconductor Mission 2.0, which funds the semiconductor manufacturing projects like those taken up by Tatas and Adanis, and also it funds the OSAT facility that Kaynes is setting up in Sanand, Gujarat. Now let's talk about some other tidbits and bits of information about Kaynes. The shareholding pattern for the company is quite healthy, with a promoter's shareholding of about 57.75%. The FIIs and DIs have a healthy share of about 15% each. The public holding is just about 12%. So the shareholding looks okay. The debt to equity is 0.27, which is great. But the new capex is coming, so the debt levels can go up. Lastly, I want to bring up a couple of concerns regarding this stock. One is the high valuation. The PE is around 115 based on the year-to-date profit of 259 crores. As I said earlier, the PE had touched a high of 173 in first week of this year, and now has seen a correction in the past 30 days. The PE of 115 is still quite high. However, keep in mind that this is a growth firm with about 30 to 50% growth in revenue projected each year and a margin of about 15% each year as guided by the management. The revenue is supposed to touch about 9,000 crores by FY28. At least that is the current guidance from the management. Another area of concern is the cash flow situation. Though the company reported an operational profit of 272 crores in the last fiscal, the actual cash from operating activities stood at just 70 crores, with high receivables and inventory levels. In fact, in FY23, the operating cash flow was negative, minus 42 crores, even though a profit of 171 crores was generated. In FY24, the payables of 145 crores was almost same as the receivables, which was, I think, around 142 crores, which makes you wonder if the company is holding up its payment to its suppliers, waiting for customers to pay for their deliverables. This cash flow situation has been brought up in the con call with the management in the recent quarterly results, and they indicated that the cash flow situation is expected to improve in the coming quarters. The management maintains that their customers are government-linked entities and large OEMs who enjoy a longer credit terms. They have healthy financials and carry minimal credit risk, and hence there is little risk of defaults by their customers. That is what the management is indicating. Again, according to the management, to avoid supply chain disruptions and to ensure smooth production, they maintain high levels of inventory and strategically stockpile raw materials and critical components like the semiconductors. The higher inventory levels are also due to upfront stocking of raw materials for the new projects and facilities of Kaynes. This situation is expected to ease as the supply chain stabilizes and as the projects scale. So other than the valuation and the cash flow situation, I don't have much to say about this firm. The management seems to be good and their customer retention is quite high. Their first customers are still with them, and probably that is the reason why they enjoy higher margins. So that is what I have to share with you on Kaynes. Hope you find it useful. Before investing, you will need to do a more detailed study. Not everything can be covered in a single video you see. So this video is for information only. Do not take it as a buy or sell recommendation. Thanks for watching. Have a great day.